Hey, what's up guys? Omar here, broker and CEO of Alden Mortgage and Ome Realty. So this is going to be another mortgage rate update. And on top of the mortgage rate update as of 8/3/2022, we're also going to be talking about credit card balances that jumped up and foreclosure rates and how much is it going to take for it to go into what's called a crash rather than a correction. Now, if you didn't know, a real estate correction is going to be anything where prices decrease by 10%. A crash will be anything over 20%. So we're going to be looking at how many foreclosures are currently right now, how many foreclosures we had before, and then we can kind of try to see if we can make sense of this debacle that we're in right now. So as of right now, we're going to be sitting at 8/3/2022, and we're going to be pricing out 10 different mortgaging products. We're going to be pricing out a 30-year fixed. 30-year fixed will be sitting at 4.45%. 15-year fixed will be sitting at 3.56%. 30-year high balance will be sitting at 4.76%. DSCR loan, which is a debt service covered ratio loan. This is a loan that does not require your W-2s, your any of the pay stubs or any of that stuff. The only thing that we look for, these are income producing properties, excuse me, that you are going to go ahead and take money coming in as a form of rental income. Then what we're going to look to see if the debt service is going to be, which is your principal, interest, tax, insurance, is going to be covered in a ratio that we go ahead and build. Now the ratio, typically you want to stay between 1.25% and higher, but we could go as low as 1%, even 0.75%. I highly discourage that. That's stupid, but some people have different business models. You want to build your portfolio, whatever it is, and you could go ahead and cover the cost, whatever it is, but that is going to be sitting at 7.85%. Bank statement loan is going to be sitting at 7.63%, which that's another one of those where we don't care about your W-2s, your bank statements, or anything like that. We look at your bank statements for the last 12, 24, 36 months, whatever is going to be required, and that is going to go ahead and determine your total income, your debt to income, and that will be a ratio as far as what we calculate, and that'll be sitting at 7.63%. FHA 30-year will be sitting at 3.79%. 7/6 adjustable rate mortgage will be sitting at 4.52%. USDA 30-year fixed, which is one of those zero down payment programs, that'll be sitting at 3.83%. VA 30-year fixed will be sitting at 3.99%. Hard money fix and flip will be sitting at 9.25%. Now the VA and the USDA, those are zero down payment programs. The VA is for veterans, but credit card balances did jump up 13%, which is the highest leap in over 20 years as inflation outweighs the wage growth. Now inflation is like 9.1%. The increase in wages are at 5.1%. So there is a bit of a discrepancy. The majority of people, especially here in America, they're saying, you know what, I'm losing my ass over here. It's so expensive to go to live. So the national average, which majority of Americans say, according to the Census Bureau, is that Americans now are looking somewhere between $107,800 a year in order for them to feel comfortable. Now, in some parts here in California, stupid fly. Now, some parts here in California, even $107,000 is not even close to being enough. Now, for instance, in the Bay Area, $116,000 for a family of 3 or 4, I believe it is. Anything under $116,000 would qualify you as low income. And then of course the more little sex trophies that you popped out, then you're going to go ahead and have a higher income bracket for you to still be considered low income. Now that's in San Francisco, Los Angeles, Orange County, especially in the medium home prices over here has toppled over $1 million in all the counties for the most part. The major counties, San Francisco, Los Angeles, Orange County, San Diego County, it's all really, really relatively high. Now people are kind of like, you know, now, because majority of people don't have that financial stimulus coming in, they don't have any extra money coming in. So now what they're doing is, you know, what do? You use credit cards. You use your credit card because you just don't have the money to buy whatever it is that you want to go and buy at that time, regardless of what it is. So even though more than 69% think their income isn't keeping up with inflation, a fewer than half said that they're feeling financially secure enough. We're okay. We're not that bad. And then if a recession happens, now there's going to be a difference between, because we're going to have a few more interest rate hikes, right? We're going to have a couple more coming up here, about 3 total. Now, the feds are going to wait about 8 weeks from the last increase from July 27th until it's coming up whenever they decide. Typically, they said it's going to be about 8 weeks coming into the winter months. Now, it's going to be probably another 0.75 basis points, which is 0.75% total. I don't know how much they're going to split it. They're talking about 3. They're trying to play it by ear on the market, but it's going to take such a long time for them to kind of balance the inflation rate and balance out the total margins on it. They're not doing really good job. I don't know what this whole trickle method is. So back in the day, and I know I said the story many times, but I'll say it again because you know what? I just like it because history tends to repeat itself. But what we have to do is we have to look what happened in history and then go ahead and work it to into the present. We already had this whole entire influx of money going into the economy, and then we had to do something. Now it was called the Volcker shock. Now the Volcker shock just said, you know what? Inflation is going to get out ahead. And inflation pretty much deems the dollar worthless, right? So everything is going to start increasing, and then so it's like you're going to go get a Big Mac meal at McDonald's, and it's going to end up costing you like $1,000. But that's because money doesn't mean anything. Inflation 101. There you go. That's what it is. Now, what we're going to go, because we are a real estate channel, and this is what I do. I do mostly all real estate. Now we have to go ahead and take a look at the debt, okay? So the total debt that we have, household debt and credit developments in Q2 of 2002, which is mortgages, which is total of $11.39 trillion. Home equity line of credit is $32 billion. Student debt is $1.59 trillion. Auto debt is $1.5 trillion. So these are all kind of big, right? We have a total of $16.15 trillion in debt from Q2. Now that seems like a big dollar amount. So what's the change? Is there really that much of a change? And what's the delinquency? That's the most important thing. Like, what is the delinquency? Well, mortgage debt has increased from 90 days or more delinquency by 0.1. which was at 0.34, now it is at 0.44. Home equity line of credit is the delinquency. Now, home equity line of credit, if you don't know what a home equity line of credit is, a home equity line of credit is just like a big credit card that you use against your house. So like, let's say for instance, your house is worth, I don't know, $800,000, but you only owe $200,000. You could go up to 80% loan to value, and then you could go ahead and use that equity that you have in your house up to 80%. And use it as a big credit card. So let's say you have $500,000 as a home equity line of credit. You want to go ahead and just, start using it. Now here's the kicker. Home equity line of credit has a draw period, the amount that you could go ahead and take out over the next 10 years. Now, whenever you have the next 10 years concluded, because you're only paying interest only, and you're taking a little bit here, it's a little bit over there, then after the 10 years, it goes to an adjustable rate mortgage. This is what's called the portfolio loan. This is one of those still subprime mortgages that are still in effect today, and there's a lot more. Of course, the non-qualified, non-agency loans that we have. Now, those are coming to term. That means that the influx in interest is going to go ahead and go correlated to the home equity line of credit. Now it's going to be a bit of a sticker shock when you just wake up one day and you're like, oh man, I put like $300,000-$400,000 on this home equity line of credit. Now I have to go ahead and pay it like whatever the rate is at that depository institution. Now you're kind of stuck between a rock and a hard place because everybody who refinanced already. And now rates have increased. Now it's still not as bad as it was. The rates are still not that bad. Of course, mine aren't that bad. Now what we have to go ahead and do, and we have to look and see what the foreclosure rate is. Now the foreclosure rate, total property filings on foreclosure was 164,581, with California and Florida, which are typically going to be on the highest side of things. Those are the biggest ones, with California at 16,340 and 17,624 in Florida. Now the other question is what is actually a bad situation? Now the only situation that we have where there's been such a big recession was back in 2008 when the real estate just took a big dump. Now back then we had a total of 3.7 million foreclosures. Now it's still going to take a little bit of time for everything to kind of play itself out, but that's going to be your mortgage rate update. So if you like the content, please like, subscribe, comment, all that other stuff. I'd love to hear exactly what you think. What do you think is going to happen? Let me know in the comments below. For up to 0% listing on selling your current home, 50% commission rebate on purchasing your next home, or any mortgage assistance, link in the description below. Like, subscribe, comment. Until next video, guys, I really appreciate you watching. Peace.